In this video, we're going to focus on the indirect method of preparing the statement of cash flows. Let's look at how the statement of cash flows is structured. First, we have operating activities. This section shows the cash generated from the company's core business operations. It includes cash received from customers, cash paid to suppliers, cash paid for wages, cash paid for operating expenses, cash paid for taxes and interest. A healthy company must generate positive operating cash flow consistently because operations are what keep the business alive. Second, we have investing activities. This section shows how the company invests in its future. Examples are purchase of equipment or machinery, purchase of buildings, purchase of intangible assets, buying or selling investments, selling fixed assets. If this section is negative, that is not necessarily bad. It often means the company is investing in growth. But if a company keeps selling assets just to survive, that could be a warning sign. Finally, we have financing activities. This shows how the company raises capital and how it repays capital. Examples are issuing shares, borrowing money, repaying loans, paying dividends. Now that we understand the three sections of the statement of cash flows, operating, investing, and financing, we're going to look at the indirect method. The indirect method starts with profit and then adjusts for non-cash items and working capital changes. In the end, we arrive at the same cash flow, just via a different route. Now let's move from theory to practice and prepare a full statement of cash flows using the indirect method. Let's assume our income statement shows revenue 500, cost of goods sold 300, operating expenses 100, depreciation 40, interest expense 10, tax expense 20, net profit 30. Balance sheet changes. During the year, accounts receivable increased by 50, inventory increased by 20, accounts payable increased by 30, plant property equipment increased from 200 to 300, depreciation during year is 40, loan increased from 100 to 150, interest paid is 10, tax paid is 15, dividends paid is 5. Under the indirect method, we always start with net profit. Net profit is 30. Depreciation reduces profit but does not reduce cash, so we add it back. Depreciation is plus 40. Now we adjust for working capital movements. Accounts receivable increased by 50. If receivables increase, it means we made sales but haven't received the cash yet, so we subtract 50. Accounts payable increased by 30. If payables increase, we haven't paid suppliers yet, so we saved cash. We add 30. Inventory increased by 20. Inventory increase means we bought more goods than we sold, so cash left the business. We subtract 20. Interest paid is 10 and tax paid is 15. Notice, the company made 30 profit, but only generated 5 in operating cash. That's because cash is tied up in receivables and inventory. Investing activities relate to long-term assets like plant, property and equipment. Plant, property and equipment movement is opening balance is 200, closing balance is 300, depreciation was 40. We use T-account logic. Plant, property and equipment purchase equals closing balance 300 minus opening balance 200 plus depreciation 40. Cash used to buy PPE is 140. Financing activities relate to long-term funding. Loan increased from 100 to 150, so company borrowed extra 50. Dividends paid is 5. Net financing cash flow is 45. Final cash movement is operating plus 5, investing minus 140, financing is plus 45. Net change in cash is 5 minus 140 plus 45 equals minus 90. This means cash decreased by 90 during the year. If opening cash was 120, 120 minus 90 equals 30. 30 is closing cash. This company is generating very weak operating cash flow, only 5, but is heavily investing in plant, property and equipment. It's financed mostly by taking additional loans. This could create liquidity pressure if operating performance does not improve.